Welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. Now let's make some money and hopefully get a lot smarter. I have a real exciting guest on with us next, someone whose work I've followed for many, many years and always enjoy reading his work. That is Morgan Stanley, Chief U.S. Equity Strategist and Chief Investment Officer, Mike Wilson. Mike, good to see you. I'm sure you know this. You're one of the most popular people on the street. I'll just lay it out there.
Well, it depends on how you qualify popular, but yes, I guess.
I want. I
We're,
really.
we're, we're well read. We're well read. Let's put it that way.
Well read. All right. Well, that's a good middle ground, my friend. So, before we get into your note, always really amazing work by you and your team. Is now just one of the toughest times to do what you do? You have stocks still at a record. You have small caps pushing higher, and then we're a couple months away from election. I mean, take us inside how you go about what you do.
Yeah, I mean that's a great question, Brian. It's something we've written about and talked about quite a bit. We almost a year and a half ago we said, look, we're entering the most challenging time of the cycle, which is the late cycle phase, because what you end up having to deal with is this excitement about the Fed, getting to the end of its hiking cycle. They're going to start cutting at some point, and that's typically really good for multiples at a time when your growth indicators are deteriorating. Okay. And so you had this sort of internal conflict as an analyst where, growth is deteriorating, but multiples are going up because of the hope for the Fed to ease policy. And this particular period has been extremely challenging, I think, for folks who do what we do, because it's extended for so long, right? Typically you're in that suspended phase for, I don't know, 6 or 12 months, but we've been in this suspended phase now for almost 2 years because of the policy mix that's been unusual in this particular cycle. We've written a lot about this, as you know, which is, we think the most, sort of distinct feature of this policy situation post-COVID is that we've had extremely tight monetary policy because inflation got out of control. And that's why the yield curve has been inverted now for almost 2 years. But at the same time, the government has been spending gobs of money on fiscal to kind of keep things moving along. And that mix it's been challenging for the Fed to manage, right? Because they're trying to slow things down, but they're kind of fighting themselves with the government spending money and keeping the aggregate statistics too hot for them to really cut rates. So we had this then liquidity coming into the picture, which is also being managed by the government to help fund this excessive fiscal spending. So that has created a situation we call crowding out. I think we've been unique in that view. And what that's done is the market has done exactly what it should be doing. And that's why we have such narrowness in the market. You think about it this way, right? The government is this giant blob that's crowding out most participants in the economy, whether it's consumers or smaller businesses or businesses without scale. We're having a hard time dealing with the higher interest rates, the higher prices of input costs, labor costs, et cetera. And so the only stocks that have really done well are these large cap, high quality, machines that aren't affected by that crowding out because they have unique business features. Either they're monopoly or they have scale and they're really efficient at managing their business and they can kind of navigate what's a very challenging environment. So that's where we are. We don't know how long this environment's going to persist for. I think, and we'll probably talk about it, but I mean, and I'll shut up in a minute. This broadening out that's sort of happening near term can be interpreted a couple of different ways. I think our view is still we don't really believe it, and we can get into some of that if you'd like.
Yeah, definitely, absolutely. We're going to get into that. But when you interact with some of the largest investors in the world, when you pick up that phone or you do a Zoom call, Google call, whatever you use, how nervous are they headed into this election? Now, what do you hear in their voice compared to prior election cycles that you've worked through?
Well, I mean, most investors, look, the election itself, every 4 years, every 2 years, really, it's more of a sideshow to, generally what investors are looking at, right? Investors are looking at our individual company fundamentals, okay, the macro environment, and to be honest, I mean, the election's interesting, but the business cycle itself and company fundamentals typically override the outcome of the election. We wrote about that this past week quite a bit, and we actually talked about this going all the way back to 2016, 17. It was one of our first notes that we wrote when we took over coverage of the U.S. equity strategy in early 17. It was like, look, everybody was so apoplectic about the outcome in 16. They were not focused on the fact that we were coming out of a global manufacturing recession and we were early cycle in many ways. And it was a very fertile time to be fully invested in equities broadly. And we got that one right because we were firmly focused on the business cycle. And so we're doing the same thing now. We did the same thing in 2020, by the way, which was even a better time frame because you were truly coming out of a global recession and the pandemic. And so, the election outcome wasn't that important. What was important is that you understood where we were in the business cycle. And that was actually the best time. Early 2021 was extremely good for kind of pro-cyclical stocks, early cycle winners. And now it's just not that, Brian. We're in a late cycle environment once again. People are getting excited about potentially, the outcome of the election and how that may affect kind of cyclical stocks the way it did in 2016, 17, or it did in 2020. And that's just not where we are. We're in this firmly in this late cycle environment, and you should be focused on high quality stocks that can navigate what is a challenging business environment, quite frankly. And we actually think, given where valuations are, you've already stretched that, banana as far as you can.
Yeah, and just to reiterate that point, in your note, I mean, you don't pull any punches. You say this, quote, it's better to be more focused on the cadence of the business cycle than the outcome of the election. Given where we are in the business cycle from where you see it, Mike, is it better for investors to focus on stocks that would benefit from rate cuts should they happen later this year?
Yeah, I think there's an appetite for that for sure, and that's once again this where we are, and I think we've traded this Fed pivot now like 5 times.
Yeah.
It's really remarkable, right? Because it's been this start-stop situation where the Fed has kind of promised and then had to back off, and because the data hasn't really supported their ability to go forward yet with that first cut. Because when they do that first cut, they're kind of committed. That's a big thing for the Fed to say, okay, now we're actually cutting rates. They don't want to reverse course, so they want to make sure, which requires the data to be, a lot softer from an inflation standpoint. We're making progress in that regard, and we think we will get there. But they've been very slow, and ironically, I think because the curve's been inverted now for 2 years. Okay, ironically, I think that when the Fed actually cuts, the market, dynamics may change in a way that people are not really expecting, which is that's kind of the beginning of the end. We'll have to see. I have no idea, right? I mean, we don't have a crystal ball. So I think there's two camps on this. One is the Fed can cut 2 or 3 times this year, on its way to cutting maybe 5 or 6 times over the next 12 months, and that will begin the long process of the market adjusting to sort of a mid-cycle, soft landing scenario, kind of like the mid-90s. Or they're going to start cutting, and they're going to realize that they're way behind the curve, and they're going to be cutting a lot more than what people are projecting right now, and that's never good for equities, right? Because that's basically the cycle's over. And I think, I don't know what the odds are, but it's not 90-10 soft landing, okay? Is it 50-50? Could be. Is it 60-40? I don't know. I mean, but that's where we are. We're in this suspended land, and so that's why we look at the markets to tell us kind of, well, how's the market interpreting this? And the market's been very fickle about this. It's gone back and forth. Some days you get a signal that it believes the soft landing, and some day you get signals that it believes in the hard landing. So we'll have to see how this goes, but I don't see that kind of confusion within the market changing until we get to that first cut.
I'm going to use some really bad corporate jargon. I want to double click on something you just said on potential for, that rate cut being the beginning of the end. So let's say the Fed comes out this fall, cuts rates. Is that mean peak multiples for stocks, or is that the sign where you rotate out of some growthier names and you get a little more defensive because growth may slow down next year?
Yeah, I mean, look, first of all, we don't need a recession, okay, for growth expectations to be disappointed. And this has been our point here recently, which is, and we're not looking for a recession. That's not our house call. Our house call is a soft landing, but our house call is for further deceleration and growth, okay? And I think the difference between the second half expectations and the first half expectations is that the first half expectations were very conservative. There was no growth really priced into expectations from an earnings standpoint, like broadly speaking. But now there's what we call the proverbial hockey stick of growth expectations, particularly in the fourth quarter. And so if we don't see a growth acceleration, okay, from an economic standpoint, those earnings expectations are going to be disappointed. And that's really where we are right now, Brian. And I think that would lend itself to, once again, wanting to own stocks where the expectations are either low or where the fundamentals are unique enough that they can buck the trend of the slowing kind of economic growth and exceed the expectations that are built into the estimates. And that's a narrower subset of stocks. And yes, it does lend itself to going more defensive now as opposed to growth oriented. So high quality growth has been the place to be. We've been highlighting that for about a year now. We've been on that train. And now we're saying maybe you barbell that a bit more with the high quality defenses as we go into this, what I would call deceleration growth environment that's not priced into the stocks or priced into earnings forecasts for a large majority of companies.
Hang with us, Mike. We're going to go off for a quick break. We'll be right back. All right, welcome back to Opening Bid. Following, we're talking really a great conversation. One of my favorite people on the street, that is Mike Wilson, Morgan Stanley Chief U.S. Equity Strategist and Chief Investment Officer. Mike, before I break down some of the other, I wouldn't say calls, but topics in your latest note, are you still looking? Are you still looking for a 10% correction? I saw that cross the wires a couple weeks ago. Could you break this down for us?
Well, the way I would characterize it is we think that the third quarter is, seasonally bad, and that's not a crazy statement. And so look at the second quarter. There was a big rally into the earnings season. That's typical. You get seasonal strength. We got that into the earnings season, and now we're expecting a give back of that. So yeah, we think this is the time for consolidation of the gains. And this, by the way, that's under a scenario where the economic and kind of background for stocks remains constructive, meaning the soft landing Goldilocks outcome remains in place. So even with that as your assumption, you should have the seasonal period for contraction is now. And so yeah, the reality is that you also have a lot of things going on between the election, between the earnings season, which we just mentioned, which is already starting to be kind of a sell the news event to some degree, which is normal at this time of the cycle. And then it's just the trading gets a bit thinner in this period. Everybody's on vacation and stuff like that. So the vol, that's probably the better way to put it, is we expect vol to pick up into the third quarter, and that usually leads to multiple contraction.
I feel as though, Mike, it is important to distinguish between your rolling bear market call. What was that, 2022? I mean, you nailed that. I mean, this is just a different call at a different time, correct?
That's right. We've had the rolling correction, if you want to call it. We invented that term, kind of the rolling recession, rolling bear market back in 2018, and we kind of regret that because now people have adopted it, and I think they've misused it to some degree.
Sorry to bring it up, Mike. I'm sorry to bring it up. No, I just had to.
Fine, but I want to clarify that for people, which is, the rolling recession, okay, is not unique. That's the way it always happens. Meaning, you get. Not every sector has to be in a slowdown. Okay, usually it is manufacturing first, and it turns into services. It's just this one was more extreme because of the pandemic, meaning you had a bunch of pull forward of demand. People were stuck at home for the goods sector, so that one obviously went into recession pretty hard last year, or in 2023. And now we're seeing, and services actually are really slowing down. Okay, in a big way. And goods are picking up again. So here we are again, Brian, in this sort of confusing environment where you have manufacturing accelerate, or not accelerating, but it is accelerating off a low level. We're not in expansion mode yet. So for example, the ISM, the PMIs are still in contraction territory, but they're not as negative as they were. And that's getting people somewhat excited that we're like early cycle. And to me, that's just a bad interpretation. Okay, where we are is late cycle still. Where manufacturing is getting less bad, okay, but services now, which is still 70% of the economy, is now weakening substantially. Okay, we actually had a first negative contractionary number in the services PMI last month, and that's something that we're focused on here. We're going to get an update from the S&P PMIs here this morning. Something to watch here closely.
So I'm reading your note, Mike. I got a couple pages in. I'm like, oh, this is really good stuff as always. And then I see one of the companies that I love talking about and I love following. That is NVIDIA. So it's good to see it in your note. Is NVIDIA the most important stock in the market? And can you make the argument that is the most forward-looking indicator on how growth may look like over the next couple of years?
Well, I would characterize it as that AI itself as a theme is without question the most important theme for the market that I've seen in really 20 years. Okay, like the AI theme is buoying, everything that people can attribute it to. So, for example, companies that you might not even expect to be talking about AI are mentioning it, and then the stock gets a huge lift. We're seeing it across power gen. We're seeing it across industrial companies. We're seeing it across your traditional semiconductor area, the sort of enablers of this technology. And we're seeing it everywhere. And so, to me, any kind of evidence that AI is not going to, lead to this productivity boom in the very near term is the risk. Okay, like we're in the phase of this technology development where you don't have to prove it out, right? It's a story, and it's exciting. Okay, like we're believers that AI will lead to productivity increase over time. Okay, not this year, that's for sure, and maybe not even next year. And so until it becomes like necessary to prove it out, then this can be the hope that buoys a lot of stocks, and that's what's been going on. And that's also coming at a time when there's a dearth of things to get excited about. Generally speaking, there's a few other themes like GLP-1s or maybe defense spending because of the conflicts that are going on around the world, things along those lines that have captured people's imagination. But generally, AI is sucking all of the oxygen out of the room. So it's not just one company, but now I think we are entering that dangerous part of the story where we need to see it in the numbers. Okay, as I like to say, I see AI everywhere except in the numbers. Outside of a few companies where it's obviously been dramatic, it hasn't really driven revenues and earnings anywhere.
No, I haven't really seen it myself, too, Mike. I mean, you pull up, I look the earnings from Alphabet. I look at some of the service plays. You see Salesforce a couple weeks ago. I mean, that AI. Well, is that the biggest risk to the AI trade? That that over the next 12 months we may just not see enough growth in AI-related services in some of these companies, and it may disappoint the market and let a lot of people down betting on this theme.
Exactly. So it's not so much that AI is not a real theme. It's just that the expectations got ahead of the timing of this development. And you never know when that moment could arise. And by the way, maybe it doesn't arise. Maybe this stuff surprises us on the upside, and all of a sudden the third quarter results, and all of a sudden you see all this incredible stuff happening. It's possible, but more likely is you get a reset, and that's also why the third quarter could be a period when you get a little reset on that, and then we'll see. And then we'll see how it develops from there. But it's always about what's priced into the stock, and you never know what's priced into the stock until you get an earnings report, for example, and then how the stock trades. One of my pet peeves is, this is not a new thing. This has been going on for years, but it's gotten a little extreme now, where the analysis about how a company's quarter was is almost 100% dependent on how it trades in the aftermarket.
Yeah.
So if the stock is up, they spin it as, oh, well, this is great. And they make up a storyline. And if the performance is bad in the aftermarket, they'll spin the quarter as not so good. And that's just lazy. But I see that now kind of all over the place. And that's not just related to AI, by the way. That's kind of across all sectors and all kind of themes.
I'm going to have to resist diving down that rabbit hole because I personally think companies should be reporting once a year. But we'll take that offline. We'll have you back in a couple months, Mike, and we'll discuss maybe that one further. And I hope, I also caught a chart in your latest note, Mike, and I hope I read it right. We'll see. My interpretation was of this particular chart that earnings growth for the Magnificent Seven, some of these very big tech companies, is set to slow over the next, let's say, 12 months. You might get some better earnings growth out of the 493 other companies in the S&P 500. How do you think investors will take slowing growth out of the Mag 7 names?
Yeah, the way to interpret that is what we're seeing is a deceleration in the growth off of crazy high numbers. So remember, in the fourth quarter of 2022, that was all part of our sort of fire and ice theme when we got right, which is that the big seven or big cap growth stocks had a very bad fourth quarter 22. Okay, it was a big payback in demand. They had negative growth, and that set up then this incredible growth last year. It was driven mainly by cost cutting, okay, for a lot of those companies. It was not top line, it was really cost cutting because you had easy comparisons in 22. So you had incredible growth in the fourth quarter of last year. Like we're talking about like 40, 50, 60% year-over-year earnings growth for some of these big companies against easy compares. And now all that's happening is you're going against tougher compares and you're seeing a massive deceleration from sort of 40, 50, 60 down to 10, 20, 10, 20, even maybe single digit growth, which is still positive, but that deceleration could weigh on multiples. On the other side, you had the 493 potentially going from negative growth last year. Let's not forget that 2023, we were in an earnings recession for the majority of companies, which is why the Mag 7 did so well relative. And now they're comping against easy numbers. So that's what's going on. I think that explains some of the rotation that we're seeing here recently, and that's good. That's a positive development. The question is it going to be good enough for that rotation to sustain itself? And there we're a little bit skeptical because we're not in the camp that top line growth is going to accelerate, because we're in the deceleration camp from an economic standpoint. Even though we're expecting a soft landing, it's still decelerating from a top line perspective, and that's going to be really challenging for a majority of companies.
Mike, about 30 seconds left here. What's your biggest fear on markets at this point?
Well, I would say that the fear that people should have right now is that valuations are so out of bounds that, over 10, it's impossible to predict the market over 6 to 12 months, okay, consistently. And we've had some success with that, but, we can't bank on it. What we can bank on is that I know exactly where the stock market's going to be over 7 to 10 years based on valuations, okay, so with like a 90% certainty. And unfortunately, given where valuations are today, the 10-year view on stocks is just not good, okay, for like, say, large cap U.S. stocks. Now, 10 years, who knows? I mean, who knows when that's going to reset? But that reset can happen at any time. And so that's what worries me, is that there's some event, there's a new shock that we can't predict, and then all of a sudden that reset on valuations happens quickly. We just don't know, okay? We just don't know that. That's our bear case. And there's plenty of candidates out there for some sort of a shock. Now, on the other side, just so the other side too, is that the other thing that on the upside is that we continue to see this policy mix where there's incredible fiscal, it's funded by other forms of spending from the government, and we just have a blow off kind of bubbly top. Right? That's also dangerous because it forces people to buy things at bad prices.
Sure. You're always at the top of your game, sir. That's why I always love catching up with you. Morgan Stanley Chief U.S. Equity Strategist and Chief Investment Officer Mike Wilson, thank you for making time with us. We'll talk to you soon. Keep sending those notes over.
Thanks, Brian.
All right, and that's it for the latest episode of Opening Bid.